Imagine your city just lost one in every 14 jobs. That's what a recession can look like, but how does it start? It often begins when businesses cut back, maybe because they're not selling enough. When sales drop, companies may lay off workers to save money. And that's where the chain reaction starts. Fewer jobs mean less spending power, and when people spend less, businesses suffer more. But there's a common misconception that recessions only happen during economic crises. Actually, they can start from something as simple as high interest rates discouraging borrowing. For example, when the Federal Reserve raises interest rates to cool an overheated economy, it makes loans more expensive. This can slow business expansion and consumer spending. So why does this matter to you? Well, a 2019 study found that the average American family lost about $5,000 in income during the last recession. That's real money that could be your savings or bills. The key is to stay informed and prepared. Recessions are natural parts of economic cycles, but understanding them can help you protect yourself financially. Money Mechanics decodes how the economy's gears turn one mechanism at a time. Stay tuned to stay ahead.